Paul, thanks for joining me today for a mortgage market update for July.
Of course, Shana, thanks for having me. Lots of exciting things happening. Excited to get into it.
All right. So I'd love some insight from you. I have a lot of questions from my clients and buyers, and I'm going to try to keep it to 5 questions.
Let's go.
Okay. So tell me, what kind of clients and products do you typically work with?
We encapsulate it as simple and profitable mortgages for complex people. So who are these people? Usually it is a newcomer and or a investor and or a business owner. All of the people that have a lot of extra paperwork to tell their story, and a lot of it stems from tax write-off because we all want to be profitable. You want to have a smart tax strategy, and you might be doing that through a holding company, an operating company. And these are things that banks or other FIs don't really grasp all the time. And you have to tell their story properly as if you're on Dragon's Den pitching their story. And luckily we do have a bit of experience there. So that's kind of the high level of it. Specifically, it's residential, commercial real estate. Commercial especially has a lot of tailwind with the recent CMHC changes. But yeah, people that are building, homeowners for construction loans, we need inventory, and it's supporting those people that are contributing to inventory and are contributing to the GDP of course, the economy. And those are a lot of business owners and entrepreneurs.
Yeah, great insight on economic growth. Thanks for that. So I'm going to jump into it. The number one question I'm getting is, when are the buyers coming off the sidelines?
Great question. I think buyers need to have confidence that the rate decreases are a pattern. And now that we've had 2 in as many months, that I believe is the beginning of the threshold. We'll see what happens in September. So if it's 3 in a row, I think that's going to be pretty resounding. For example, right now, like financially, if you had a $500,000 mortgage or about to have one, since the first decrease in 4 years in June, you'd be saving $260 a month now based off these last 2 decreases, or rather, sorry, $130. Now, if they do cut another 0.5 until the end of 2024, you can double the 130 to 260. So 260 by the end of the year is how much you're saving a month approximately. If you have a $500,000 mortgage, you got $1 million mortgage, you can double that, right? 520. So that is enough for some people to, budget a little bit better. But more importantly, it is the pattern that they'll go down even more in 2025. That's what people are really getting ready for, and this is a good early preview for it.
Yeah, I couldn't agree more that buyers are looking for another at least one more rate drop to jump back in. Mm-hmm. So for buyers looking to get back into the market, what do you suggest they do to get pre-approved in today's housing conditions?
Definitely. Talk to your broker and make sure you can do a pre-qualification. So if you don't have all the documents, you don't want to get your credit check, just get a gut check at the very least. This could take literally 5 minutes. I always recommend to do more of a full one. And what's disqualifying a lot of people is thinking their credit score is higher than it is, and it's not. 680 is the threshold we like, 600 at an absolute minimum. And just keep your debt low. Car loans are a killer for that. Even if you're a business owner and it's like a business expense, you still guarantee it, right? So it's still going to be on your credit bureau. Very hard to get around that unless someone else takes over the car loan. That can take time, etc. Remember, elevated rates mean elevated stress tests, and so every cent really counts. So you can do. It can take a long time to course correct your expenses or even to make more revenue. Those are 2 things that qualify you. So if you know what the gap is now, if you have to pull one of those levers, or just have a cosigner in your back pocket, and that could take some convincing at the dinner table, right? So budget some time for that.
Yeah, that totally makes sense that you'd want to be ready to go months in advance of when you started to look. Mm-hmm. So tell me, how many lenders are you currently working with or do you typically work with? And what are some challenges you've seen recently with getting mortgages approved or requalified?
Definitely. The network is 50 plus. The ones we go really deep with are probably just under a dozen. Anywhere from Scotia and TD, right? Preferential rates there, all the way to like First National, MCAP, 2 public companies, People's Bank, even EQ Bank, right? On the alternative side, a lot of people are qualifying for B lenders now, right? As A lenders get tighter and tighter. Right. And what are the there's a lot of challenges getting approved of them, but that is generally how we work with them. I would say with when you approach these banks, you just really gotta have your paperwork ready. And there's just, I don't know, a lot of people do not keep track of their paperwork, and that becomes an issue. With the lenders, a few different angles. And your second question was again?
It was to do with people getting requalified. So they're already in the market and, the term's up and they're looking to get it going again.
Yeah, I mean, the challenges are, again, just changes in income, as I said in the last point, and just when they've got, very high debt. But it takes 15 minutes to get requalified. It's not hard. You just got to, carve out the time and talk to the right professional. But yeah, if you can't get pre-qualified with A lender, you got to look at B and C lenders, and they do have other fees as well. Like they've got upfront lender fees and things you got to budget for. So just see where you stand and understand if your story is compelling. Ideally for A prime lenders, but it could also be an alternative lender, and they'll just be different numbers. So those are all things we can do pretty quickly.
Right. Good to know that the requalification process is quite a bit quicker than getting approved the first time. So it's been in the news, as you know, given the rising interest rates in the last year or so. The aftermath now has been some delinquent or default mortgages, unfortunately. In some cases, foreclosures and even insolvency from developers. Do you see that continuing to happen?
Probably at around the same pace. I should say the mortgage arrears in Canada are 0.18%, which relative to the US, which is 1.52, we're about, at least 5x less than them. Obviously a little bit more like 7x. So relatively still low. I wouldn't see cause for panic on the actual borrower side, but on the developer side, I mean, you have more insight on that than me, but I mean, it looks like there's still a lot of high expenses, and unless you're CMHC backed on the commercial side, it's going to be pretty hard to make those profitable. So it'll be interesting, but I think we'll get out of it as we usually do. But we're still in the middle of it.
Right. Yeah. Good insight. Thanks for sharing that. All right. So, one last question today from my buyers. If they wanted to break their mortgage and requalify at a lower rate later this year, given the rate that's happening, what would you advise them?
Really depends on what the breakage penalty is going to be. If you're on fixed, that's going to be something called interest rate differential, aka IRD. And whatever the gain you would get on you break from a 6% to a 4%. If you still have a handful of months left in your term, I mean, that could all be wiped through the IRD penalty. We have a special calculator for that. And really, it's if you have a lot of months left and the rates go down dramatically since you locked in, which is probably why you want to break. It may not be worth it. I think it's more worth it if you have a variable rate that you're breaking, which is why I think variables are still strong, especially now. A better call might be to refinance. If you have to break it, refinance it for a purpose. Take out some equity, and hopefully it's for a down payment on that next investment property, which hopefully you're getting at a deal, especially if the market's pretty soft. But in short, fixed rates are really hard to break right now because this is usually a pretty big penalty. Banks, big six banks have higher ones than the monoline lenders like First National and MCAP. So if you did go the non-bank route, that might be a smaller hit, and we can run the math on it.
Good to know. So it sounds like it's a case-by-case basis that you need help with. Mm-hmm. Okay, so I just want to thank you again so much for being here today and collaborating.
Thanks for having me. Great questions.
Yeah, appreciate you instilling some confidence in our buyers to come off the sidelines. Mm-hmm. How can they reach you for more tools and support?
Definitely, levelupmortgages.com. You can also look me up, Paul Davidescu, on whichever your social channel is of choice. We also have a free first-time homebuyer course. We only give via our partners, so they can reach out to you for that. And we have a pre-qualification budget planner. It's a Excel sheet on steroids with all kinds of scenarios, specifically on, right now it's very tough to think about fixed versus variable, 2 or a 5-year term. What are the numbers? But more importantly, as I alluded to, what are the projected penalties that I might be hit with? So you get an expected value from that, right? In the next 2 years, what's the expected amount of money left in your pocket? Really depends on your strategy and whether you have to pull out more equity or whether you're exposed to breaking. So all things that we can talk about pretty quickly. I don't need documents or a credit score per se. We can do this pretty back in napkin just for you to get ready and have a bit of a sandbox to play in.
Okay, wonderful. Great insight again. And just wanted to thank you again and see you next month.
Sounds good, Shana. Really appreciate the time, and good luck, everyone.